Here's a riddle that on paper should not have an answer. Fewer young people than ever before will be able to buy a home in their lifetime. And yet home prices, after exploding to record highs, are simply refusing to come back down. So sit with that for a second. If nobody can afford to buy a house, then who exactly is buying them? And why aren't prices crashing back to earth when the buyers have supposedly run out of money? It feels like it should break. Common sense says that when a product gets too expensive for the people who want it, the price has to come back down to meet them. That is supply and demand. That is the whole rule. But housing has spent the last several years quietly breaking that rule, and almost nobody can explain why. So today we are going to explain why, because there are 3 reasons this can keep going far longer than you think, and a 4th one that almost nobody talks about. And once you see them, you will never look at a "for sale" sign the same way again. First, let's be honest about why this matters so much. A home is supposed to be the bedrock of your financial life. It gives you a place to live while you build equity in something you can one day call your own. In most cities, owning a home on a 30-year mortgage actually costs you less out of pocket every month than renting the same place. So if you can get into a home, you tend to be richer today and far richer decades from now, because every payment is quietly buying you a piece of an asset instead of handing it to a landlord. You probably already know this, and if you're like most of the people watching this channel, you don't own a home, and it is not because you don't want one. It is because the math has gotten almost impossible. The share of homes on the market that a typical household can actually afford collapsed during the early 2020s and has barely recovered. By 2026, in a state like California, only about a quarter of households earn enough to qualify for a mid-tier home, down sharply from before the pandemic. Across the country, the gap between what people earn and what homes cost has pushed affordability to some of the worst levels in modern history. So here's the obvious question. If people genuinely cannot afford homes, then prices have to crash eventually, right? They can't just stay this high forever. The answer is yes, they can, and the first reason why is the one that quietly traps almost everyone. Reason number 1, a house does not actually have to be affordable for you to buy it. That sounds impossible, but there is an entire industry built around making it true. Because here's the trick. You don't save up to buy a house, you save up for a down payment, and those are 2 completely different mountains to climb. Let's run the numbers. The average American home traded for around $230,000 back in 2020. By early 2026, the median home was selling for over $400,000. That is roughly a $170,000 jump in just a few years. Most of that explosion happened between 2020 and 2022, and since then prices have largely plateaued at that painful new high, rather than falling back. Now compare it to wages. The average American earns somewhere around $60,000 a year before tax. After federal taxes and payroll deductions, take-home pay lands closer to $50,000. So picture this person trying to save up the full price of a house. During the boom years, even saving an absurd share of their income, they would have fallen further behind every single year because the price of the average home was climbing faster than they could ever stash money away. In a very real sense, during those years, the average house earned more money than the average person did. Now that should be the end of the dream right there, but it isn't because of the down payment trick. Most people are not saving for the whole house. They're saving for a slice of it. A 20% down payment grows at only 1/5 the speed of the full price, so the mountain suddenly looks a lot smaller. And the slice you actually need has been shrinking for years. Now, scraping together even that slice is still a serious commitment, especially when more than half of Americans say the cost of living is simply too high to set money aside for a down payment at all. But here's the cruel part. In the years prices were rocketing, saving at a normal pace only let you tread water. It did not actually get you any closer to owning a home. You were running as hard as you could just to stay in the same place. Lenders and banks know this. They have an enormous interest in keeping real estate values high, and they understand that families also have to eat, pay rent, and survive everything else getting more expensive. So they did the only thing they could to keep buyers in the game. They moved the goalposts. Despite the old myth that you need 20% down, the typical first-time buyer today puts down only around 9 or 10%, according to the National Association of Realtors. There are loan programs that ask for as little as 3 to 3.5%, and a few that go all the way down to 0. And when you only need a tiny deposit to get in the door, home prices can balloon to absurd multiples of your income before buying becomes truly impossible. The smaller the slice you need, the longer the whole system can keep prices sky high and still find someone willing to sign. And if even that is too much, the industry has gone further, rolling out 1% down loan products where the buyer puts down a single percent and the lender chips in the rest of the cushion as a grant that never has to be repaid. The price of entry keeps getting pushed lower and lower to keep the line of buyers moving, but putting money down is only half the battle. You still have to make the monthly payments, and if you couldn't manage a real down payment, those payments are exactly where the trap snaps shut, especially with mortgage rates where they are today. Which brings us to reason number 2. Homes stay brutally expensive even when almost nobody can afford them, in large part because almost nobody is selling them. This is the piece most people miss entirely. During the pandemic, mortgage rates fell to historic lows, and millions of homeowners locked in 30-year fixed rates below 3%. Think about what that means today. As of 2026, the average 30-year mortgage rate sits in the mid-6% range, more than double those pandemic lows. So if you are sitting on a sub 3% loan, you are never going to voluntarily give it up. The moment you sell and buy somewhere new, you take on a fresh mortgage at today's far higher rate, which can dramatically increase your monthly payment for an equivalent house. So you stay put. This is called the lock-in effect, and it has frozen the market. Home sales fell to some of their lowest levels in over a decade, even as the population kept growing. And it is a vicious circle. People won't sell because the rental market is even more punishing, and moving means a much more expensive new loan. So they stay. That keeps renters stuck renting, which crams more people into the rental market and drives those prices up too, which makes selling and renting look even worse. Supply gets choked off from every direction. On top of that, moving is genuinely disruptive. A huge wave of people already moved during the pandemic. The typical homeowner now stays in their home well over a decade, and the number of people living under one roof has actually started rising for the first time in over a century, as more young adults move back in with their parents to escape an impossible market. The result is a strange kind of frozen housing market. It is still active, but the normal buyers and normal sellers have largely stepped aside to wait it out, and it is the people who are left in the game that make up reason number 3. Reason number 3. When the regular buyers vanish, 3 specific groups keep the machine running, and none of them care whether the average family can afford anything. The first group is all cash buyers. Picture someone who bought a home decades ago for a fraction of today's prices and now wants to downsize. They sell high, pocket an enormous spread between their big old house and a smaller new one, and walk in waving cash that no mortgage-dependent buyer can compete with. The second group is people fleeing expensive cities. When you can work from anywhere, leaving a high-cost city for a cheaper one means your big city income buys you a far bigger home. The catch is that thousands of people have the same idea, so they pour into cheaper markets and drive those prices up too. In trying to escape rising prices, they spread them around. But the third group is the one everybody loves to blame. Investors. Investors don't care about affordability, they care about returns. When prices are high, they simply charge higher rents to tenants or list properties on short-term rental sites for even more. And in this frozen market, with so many regular buyers sidelined, investors now make up a striking share of all home purchases. By some measures close to a third in 2025, the highest level in years. But here's the twist that almost every headline gets wrong. The vast majority of those investors are not giant Wall Street firms. They're small local landlords who own only a handful of properties. The big institutional players everyone fears actually own only a tiny fraction of the nation's homes, well under a few percent, and a lot of investor money instead flows through what are called real estate investment trusts, or REITs. Think of a REIT as an index fund for property. It pools money from a huge group of investors and buys up a whole portfolio of real estate. As ordinary people got priced out of owning a home, many still wanted a piece of the housing market, so they park savings into these funds so their money at least rises along with the market. The unaffordability fed demand for these funds, and the funds in turn kept money flooding into housing. A quiet, self-feeding loop. There's even a quiet fourth reason layered underneath all of this. Wealthy families are simply getting much better at holding on to property across generations. For most of history, family fortunes rarely survived past the second or third generation, but now that investing in real estate is so easy and so lucrative, we may be drifting toward a new age where a handful of dynasties hold property essentially forever, passing homes down instead of ever putting them back on the market for someone like you. So, is this circus going to run forever? No, and here's where the story finally turns. Because the same forces that propped this market up are now shifting. The big institutional investors that everyone spent years blaming have actually been retreating. By some industry estimates, large-scale institutional purchases of single-family homes are down more than 90% from their 2022 peak, with major firms selling more than they buy in many cities. The political winds turned too. In early 2026, the federal government moved to restrict large Wall Street investors from buying up single-family homes altogether. And here's the danger lurking in the funds. If too many investors rush to pull their money out of a property fund at once, the managers can be forced to actually sell buildings to raise cash. One major firm had to temporarily block withdrawals from a massive real estate fund for exactly this reason. The moment one property sells at a lower price, every comparable property has to be marked down to match it. That lower valuation spooks more investors, who pull out more money, which forces more sales, which pushes prices down further. That is exactly the kind of chain reaction that can turn a frozen market into a falling one. And this is the part that should genuinely concern you as a regular buyer. When you walk into an open house, you are no longer just competing with other families. You are competing with a downsizing retiree holding a briefcase of cash, a remote worker whose big city salary stretches twice as far in your town, and a fund manager who answers to investors 1,000 miles away and never has to live in the house at all. Every one of them can move faster than you, bid higher than you, and skip the financing hurdles that slow you down. That is why so many buyers feel like they are losing a race they didn't even know they had entered. The deck is not just stacked, it is stacked by players who aren't even sitting at your table. So the honest answer to our riddle is this: homes can stay brutally expensive even when nobody can afford them, because the down payment trick keeps just enough buyers in the game, because rate-locked owners refuse to sell, and because cash buyers, fleeing workers, and investors of every size fill the gap the rest of us left behind. It is a system that can absolutely stay frozen far longer than common sense says it should, but it is not magic and it is not permanent. The same machinery that holds prices up can throw the whole thing into reverse the moment confidence cracks. So the real question is not whether you can afford a home today, it is whether you understand the game well enough to be ready when the rules finally shift. Because they will. And the people who understand exactly how this machine works will be the ones standing in the right place when it does. If this changed the way you see the housing market, subscribe to Net Worth Nation, because understanding the system is the first step to beating it. See you in the next one. Let's build.